Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-Mini and Mini Russell 2000 equity indices, as well as the US dollar index, the euro currency, and the dollar yen. We're going to start off today with the daily log scale chart of the Mini Russell 2000 contract, still basis the December contract. Excuse me. And you can see today's or overnight's break below the November 1st low at 70.62 that we have targeted for a couple of weeks now as a key failure point that absolutely breaks the October rally attempt and reaffirms our neutral to cautiously bearish and now perhaps even significantly bearish policy that the sell-off or the relapse from the 76.84 high from October 27th is a larger degree correction or possible reversal of the entire October rally from 59.71 up to that 76.84 high. And as a direct result of this weakness, we believe the market has defined the 74.75 high from November 16th as the level this market needs to recover above to confirm the relapse from the late October high as a corrective consolidative pattern that would be consistent with a broader bullish count looking for further and possibly significant gains above that 76.84 high. Until or unless such strength is shown, not only are traders advised to be leery of further losses, but potentially very significant, even relentless losses in the period straight away. For looking here at a weekly log scale chart, and despite the extent of the October rally from a 59.71 low up to that 76.84 high relative to this year's earlier decline, it remains quite possible that that 87.20 to 59.71 decline that started from early May is just this initial A or first wave of a much larger degree reversal lower, and that the October recovery, again, as sharp as it was a B or second wave correction, a right shoulder, if you will, ahead of what could be significant losses in not only the weeks and months ahead, but perhaps quarters ahead. Looking here at a monthly log scale chart, you can see 2011's 38.2% retrace of the major bull trend from the March 09 low at 34.25 all the way up to this year's high at 86.86, basis the Russell 2000 cash index. But again, given the extent and impulsiveness of that 38.2% retrace earlier this year into that October low, and since on the October recovery, since the market did not go up and make a new high, we've got to be leery about this recovery attempt as being the same type of second wave or B wave bear market correction that the market provided in the first quarter of 2008. Before the bottom fell out in terms of that major reversal in that 2007 to 2009 period. From a shorter term perspective, looking at the 4-hourly chart here, if the past week's sell-off is just the completing C wave to a bull market corrective scenario, the initial recent corrective high this market is now minimally required to recover above to jeopardize the impulsive integrity of a broader bearish count is the 72.97 corrective high from this past Friday. That's our short-term risk parameter. If the market can recover above that, it will definitely tilt the directional scales back into a broader bullish one. Until or unless minimally such strength above 72.97 and preferably 74.75 is shown, further and possibly accelerated losses are expected straight away, and per such, traders are advised to move to at least a cautiously bearish policy or a hedged policy with strength above 72.97 required to defer that view, and above 74.75 required to negate it sufficiently to warrant moving back to a neutral to cautiously bullish policy. Until or unless such strength is shown further, and possibly steep losses should not surprise straight away. Moving to a daily log scale chart of the S&P E-Mini contract, and as we've discussed in last week's comprehensive technical report about the threats to this market should the market break below the 1208 low from early November. We maintain a bearish policy there with strength above 1271 required to negate it and reinforce a broader bullish count. From a shorter term perspective, and as we just discussed in the Mini Russell contract, Friday's 1230 corrective high in the S&P E-Mini is the latest corrective high and tightest risk parameter this market is now minimally required to recover above to defer or threaten a broader bearish count. You can see by virtue virtue of the break below the early and mid lows and support at 1208 and 1218. That former support is now considered new resistance ahead of further, possibly, excuse me, accelerated and perhaps even relentless losses in the weeks and perhaps even months straight away. Moving to an intraday 4-hourly chart of the U.S. dollar index, and not surprisingly, reflecting a possible flight to quality or continued flight to quality because of the Eurozone problems. You can see the overnight's gains above last week's resistant highs between 78.39 and 78.47. That reinforces the past month and a half's broader recovery and defines the 77.53 low from Friday as the latest corrective low and tightest risk parameter. This market is now required to fail below, minimally, to even defer this developing bull trend. From a longer term perspective shown here, you can see not only the recovery from the late October lows that confirms at least the intermediate term trend is up. You can see the possibility that over the past couple of weeks, the coiling up, the 2 steps forward, 1 step back, possibly a upward coil pattern that oftentimes results in accelerated gains thereafter. It's quite possible still that the October sell-off is merely correcting this year's earlier gains and that the U.S. dollar index is on its way to steep gains above that October 4th high at 79.84. As part of a major long-term base and reversal threat shown here on a weekly log close-only basis. As a result of overnight's gains, a bullish policy and exposure remained advised with weakness below at least 77.53 and preferably 76.72 required to defer or threaten a bullish count. Similarly, looking at a daily chart of the euro currency, the market's developing relapse from that late October high at 142.48 from October 27th. That was the exact 61.8% retrace of this year's earlier decline from 149.5 down to 131.5. That we believe is a corrective recovery within a broader developing bear trend, ultimately to new lows below that October 4th low at 131.46. You can see here on an intraday 4-hourly chart, the market has yet to break below last week's 134.22 low, but we believe that that will be imminent. And that would define Friday's 136.15 as the latest corrective high and tightest risk parameter this market would minimally be needed or required to recover above to confirm a bullish divergence in momentum necessary to even defer this decline, let alone expose a reversal higher. From a longer term perspective, last Monday's 138.15 we feel might be one of this market's most important technical levels. As a recovery above that level, moving back here to a daily chart, would be sufficient to break this intermediate to possible longer term developing downtrend sufficiently to warrant moving back to a neutral to cautiously constructive view. Until or unless such strength above 138.15 is proven, traders should not be surprised by not only a continuation of this decline in the euro, but possibly its acceleration to new lows below that October 4th key low at 131.46. Finally, looking at an intraday chart of the dollar-yen contract, it's been a somewhat boring market over the past couple of weeks as this market, we believe, has been correcting the late October recovery from 75.56 up to 79.54. We believe this relapse to be just a corrective retest of that key low at 75.56. But if that's the case, somewhere along the line, the market needs to arrest this decline, confirm a bullish divergence in momentum to define a more objective low and risk parameter from which at least cautiously bullish policies can only then be objectively based. And in that regard, and as short term as it is, we believe a 77.04 minor corrective high from Thursday afternoon, if the market can recover above that point, the market will be breaking the intermediate term downtrend over the past few weeks. And whatever low is left in the wake of that confirmed bullish divergence in short term momentum, 76.56 currently, we believe that would be a tight but objective risk parameter from which to base at least initial cautious bullish exposure to what could be an absolutely major base and reversal threat. Moving out to a weekly log scale chart that shows the secular bear trend, but that late October recovery above 77.86 absolutely confirms a bullish divergence in momentum that really threatens this long-term bear trend, and combined with what has been extraordinarily bullish sentiment according to the Japanese yen, we think all the factors are in place now for an absolutely major base and reversal environment in the U.S. dollar, versus the Japanese yen. Looking here at a daily log scale close only chart, you can see the extent of that and the impulsiveness of the late October rally that breaks at least the April through October portion of the secular bear trend, arguably completing a 5-wave Elliott wave sequence down to the low daily close at 75.82. And if that is the case, that the late October rally is the A wave or the first wave of a larger degree correction or reversal lower, by definition, the subsequent relapse or retest of the lows would be a corrective one. That must be stemmed with a bullish divergence in short-term momentum, and hence the importance of that 77.04 level discussed earlier. You can also see the market relapsing to the area of the 61.8% retrace of that 75.82 to 78.38 rally around the 76.78 area. So we want to be particularly watchful for any kind of bullish divergence in short-term momentum needed to define a low that could provide one of the great risk-reward buying opportunities of the rest of the year, perhaps in the first couple of quarters of 2012. These issues considered, traders are advised to move to a cautiously bullish policy and exposure on the immediate break above 77.04 with tight protective sell stops at 76.56 within the context of possibly a base and reversal threat that could be absolutely massive in scope. Please stay tuned to updates in these and other markets on our RJOMRT.com website, and good luck with today's trading.